Welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of ServiceNow Inc., ticker symbol NOW, now. So at the time of recording today's video, ServiceNow is currently trading for $450.77 per share. Year to date, their stock price is down 31%. Over the past year, they're down about 32%. Going back 3 years, however, they're up at a rate of 19% compounded annually. Over 5 years, they're up at a rate of 30.5% compounded annually. Over 10 years, that's 28% compounded annually. And going back to when the company was publicly listed a little over 10 years ago, since its IPO, ServiceNow has returned 32% compounded annually for just over the past 10 years. So if you've held this business since IPO, you've been absolutely killing it so far. There's a pretty huge fluctuation here between their 52-week high and their 52-week low. Currently, they're trading about $44 over their 52-week low, and they're still down more than $300 from their 52-week high. About 2% of their shares outstanding are currently sold short, and the business has about a $91 billion market cap, so this is a large business. For some background about the business, ServiceNow Inc. provides software solutions to structure and automate various business processes via a SaaS delivery model. The company primarily focuses on the IT function for enterprise customers. ServiceNow began with IT Service Management, ITSM. It expanded within the IT function and most recently directed its workflow automation logic to functional areas beyond IT, notably into customer service, HR, service delivery, and security operations. ServiceNow also offers an application development platform as a service. ServiceNow serves a wide variety of industries. It sells its products through direct sales teams and resale partners. The company was incorporated in 2004 and is headquartered in Santa Clara, California. So for our fundamental analysis today, we are going to be performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of ServiceNow based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public. It's going to continue to improve and get better over time. So with that said, let's get right into our analysis. Starting off with our first metric, we want their average return on capital over the last 5 years to be above 14%. So the average publicly listed business has a return on capital of about 7%, and over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and those business returns are going to be captured here by return on capital. So by looking for businesses that are twice as good as average, we're building in some margin of safety for ourselves based on the quality of the business. In the case of ServiceNow, they've been increasing their return on capital in all 5 of these years. However, this is still pretty lackluster. Averaged out, they're earning under 1% return on capital. So this is quite a bit below average. This potentially has to do with their business model and why these numbers look so bad here despite their huge returns. But you'd be able to understand this better by learning more about the business. Anyways, this is going to be an X for us now to start off. Metric number 2, we want their revenues, net incomes, and free cash flows to have grown over the last 5 years. This metric is all or nothing in nature. Either all 3 of these are going to be up for a check, or if even one of them is down, this whole metric will be an X. So this is going to help us get a high-level overview of the cash coming into the business and to determine whether that's growing, hopefully on all fronts. So ServiceNow has had some pretty ridiculous growth over this time frame. They've increased their revenues by over 2.5 times, from $2 billion to about $6 billion. They've also taken their earnings from being negative to now they are positive, and their free cash flow has more than tripled over this time frame. These are all great signs to see here. This is a rapidly growing business, and this is our first check on metric number 2. Metric number 3 is building off of our previous metric, but here we're taking a look at the business on a per share basis. So from the perspective of an individual shareholder, we want them to be growing their earnings per share over the last 5 years. ServiceNow does this, so this is a check on metric number 3. We also get a glimpse here that their earnings per share have grown slightly slower than their earnings over the same time frame, which signals to us that they've been diluting shareholders over the last 5 years. Not by a crazy amount, but there is some dilution going on behind the scenes in this business. So that's something that can be a silent killer to investors over time, because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. When a business is diluting existing shareholders by issuing new shares of stock, they're decreasing your ownership percentage in the business, which is ultimately going to decrease the percentage of the business's profits that you're entitled to. We don't want businesses that are excessively diluting existing shareholders. Again, while there's dilution here, this is still going to be a check on metric number 3. They've grown their earnings faster than they are diluting shareholders. Metric number 4 is very similar. We're looking for free cash flow per share growth over the last 5 years. Their free cash flow numbers have been rock solid and very steady over this time frame. In all of the last 5 years, they've increased their free cash flows per share year over year. So in 2017, as an individual shareholder, you were entitled to $2.84 of their free cash flows per each share that you held. At the end of 2021, you'd be entitled to $9.05 for each share that you held in ServiceNow. So this is another check here on metric number 4. Great to see this free cash flow per share growth, because free cash flow is the lifeblood of any business, and a business can use free cash flows in a variety of ways, including paying dividends, buying back shares, paying down debt, making acquisitions, or reinvesting back into the business. Ultimately, a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business is going to be worth. We want businesses that are growing their free cash flows for shareholders. So to recap where we are so far, through 4 metrics, we've got 3 checks. Metric number 5, we want their net debt, which is long and short-term liabilities minus cash and short-term investments, to be below the amount of free cash flow that they've generated in the past 5 years. So ServiceNow has negative net debt, meaning that after they pay off all of their debt in the business, they're still left over with $1 billion in cash. And over the last 5 years, they've generated approximately $5.2 billion of free cash flow. So this is an easy check here on metric number 5. The business's balance sheet looks like it's in good shape, and they're strongly cash flow generative. Finally, the big metric of them all, metric number 6. Typically here we're looking for their average 5-year free cash flows relative to their total enterprise value to give us a yield of above 5%. Given the nature of ServiceNow as a SaaS business with a pretty sticky product, it's likely going to make sense that we use their last 12 months of free cash flows or the current cash flows coming into the business relative to their total enterprise value to give us a more accurate picture of the business going forward. That additional level of accuracy is the same reason that we're using total enterprise value instead of their market cap, because total enterprise value gives us a more realistic economic picture of the business, as if ServiceNow were a private business, taking into account both its market cap and its net debt. ServiceNow currently has an $89 billion total enterprise value. In the last 5 years, they've generated $5.2 billion of free cash flow. And in the last 12 months alone, they've generated $2 billion of free cash flow. So when we divide their $2 billion of last 12 months of free cash flow by their total enterprise value of $89 billion, that is going to give us a free cash flow to enterprise value yield of only 2.2%. So this metric, even modifying it for a SaaS business, is still going to be an X. Currently, this free cash flow yield is both below the metric we were looking for and below the risk-free rate overall. So in summary, ServiceNow checks the box on 4 out of 6 of our metrics. They've grown their business at quite a fast rate. However, they have been diluting shareholders over the last 5 years. The business is also sitting on about $1 billion in cash after paying off all of their liabilities, and they've been generating a pretty healthy amount of free cash flows. However, relative to their total enterprise value, it doesn't look like their abilities to produce free cash flows give us any sort of risk premium over the risk-free rate. And on paper, the business is earning pretty subpar returns on capital, which could potentially be skewed given the nature of their business. Then just to mention, the business does not pay out dividends. And please make note of the fact that this type of analysis is not financial advice. It is not a buy or sell recommendation of any security. Instead, it serves as a holistic beginning understanding to learn about ServiceNow and to determine whether it's worth your while to dig in and learn even more about the business. The best way to do that is by diving into their 10K and reading through their earnings call transcripts to get a better sense of the challenges and opportunities presented by this business. And you can understand how management is going to be approaching capital allocation now and into the future. You can also get clarity about the business on things like their unit economics, their churn rates, as well as potential things like cohort analyses to get a better sense of the business overall. So as a value investor, you want to research a business and understand it as if you owned 100% of it, and you can truly understand all of its ins and outs and understand the essence of the business. Before you're potentially considering any sort of investment, please consult with the properly licensed and registered financial and legal professionals. So with that said, that's it for today's fundamental stock analysis of ServiceNow Inc., ticker symbol NOW. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about ServiceNow with me. It was a subscriber request, so I'm happy to make a video on it, and have a great day.